Did you know that most short-term themed EFTs, such as Proshares Ultra QQQ, have roughly a $1 expense ratio? What of the fact that FAMA, Facebook, Apple, Netflix, Google, Microsoft, and Amazon is the acronym for the top 6 performing tech stocks on the NASDAQ 100 in the last 10 years? There is much more to discover in today's video on the top 6 growth EFTs to buy in 2022. Let us begin. Number 6. iShares S&P 500 Growth ETF. The iShares S&P 500 Growth ETF focuses on the 240 growth stocks in the S&P 500 index. The growth stocks in the S&P 500 are from U.S. companies with a high market valuation and continue to improve daily. About 10% of these ETFs holding combine some of the most innovative tech geniuses. These growth stocks tend to be the highest and largest capitalization and exhibit tangible growth capabilities. The stock is primarily from the technology sector, with some deep engineering on a smaller scale. The top holding from this ETF is from the famous and most well-doing tech companies on the stock exchange. Currently, the fund is worth over $29 billion in assets under management and has an expense ratio of 0.18%. The downside to this ETF is that there is no space for other companies not recognized on the S&P 500. Thus, most of the performance becomes linear, leaving no room for diversified gains. But Eric Lichtenstein, managing director of Knight's ETF trading desk, said, "I wouldn't shy away from ETFs that have low volume or low assets. You just have to be smart about how you trade it." Aside from that, the iShares S&P 500 growth stock is undeniably an affordable ETF to buy and quite easy to manage due to the cap on the companies. However, another iShares ETF holds over 498 stocks and has $58 billion in assets. We will share the differences and tell you which of them is more popular for investors shortly. Number 5. Proshares Ultra QQQ. The NASDAQ 100 companies have something in common. Their performance is ever-changing. Their volatility and swift performance difficulties are why they are not trusted for long-term investments. Thus, this ETF is stationed for swing trading. The Proshares Ultra ETF gives the investors an excellent opportunity to dip their toes into the world of the NASDAQ 100 for the few days that it is high-performing before it starts declining.
Hurry up!
In fact, when you buy into this ETF, you need to keep watching predictions and go with your instincts. The exchange-traded fund leverages the daily performance returns and offers compound returns daily. Moreover, most people hold the fund as a margin trading tactic, where investors open margin accounts and receive at least 50% of their initial amount in loans to invest and pay back as they make their daily leverage. It is a game for the best traders, and one might need to stay away if they are not already fantastic at the short game. Its performance could be mind-blowing, but so is its wiped-out decline. Therefore, you find that the ETF is more expensive than the rest on this list. Proshares Ultra QQQ costs an expense ratio of 0.95%. Number 4. iShares Russell 1000 Growth ETF. In comparison, the iShares Russell 1000 Growth ETF has a more diverse performance index than the iShares S&P 500 Growth ETF. The Russell 1000 stocks offer a broader performance opportunity compared to the growth sets from only the companies under the S&P 500. Suppose you follow the stocks. You will know that sometimes the steadiest performing stocks are the mid-cap growth stocks. They might not have as much muscle as the high-cap growth stocks, but they often keep experiencing major growth rates and returns. Therefore, exploring the advantages of those stocks under iShares Russell 1000 offers the potential for higher returns and less concentration. The leading stocks of the iShares Russell 100 are the same as those from the S&P 500. However, there are 498 stocks to trade as compared to the 240.
That's the idea.
Despite being lower and having less famous stocks aboard, its assets under management are $58 billion, proving that it is more famous and a better option. Notwithstanding, the iShares Russell 1000 Growth ETF has an expense ratio of 0.19%. We have more comparisons of the same hedge funds ahead. Subscribe to this channel to find out more. Number 3. Vanguard Mega Cap Growth ETF. The Vanguard Mega Cap Growth ETF is a highly concentrated growth stock ETF. The Mega Cap Growth ETF has over $11.5 billion in its assets under management. To illustrate, the fund follows 108 stocks from the CRSP US Mega Cap Growth Index. These stocks are highly bullish and make it easier for a volatile situation. For example, 61% of the entire fund is a combination of 10 out of the 108 stocks. These statistics make it a tad heavy at the top. The holdings combine to produce over $544 billion in weight, and the Vanguard Mega Cap Growth ETF stocks are on the largest proportions. To compare, 53% of the stock holdings can be attributed to tech companies. Consumer discretionary follows with roughly 25% of its total holdings. This growth stock ETF will cost you around 0.07% to manage. If you are confused about the small nature of this ETF, know that the ever-famous Vanguard Growth ETF is different. As the originators of index funds, VG hosts 266 large-cap stocks. What you will not believe is the expense ratio. We will tell you all about it shortly. Number 2. Invesco QQQ ETF. The Invesco QQQ is a high-performing ETF that tracks the Nasdaq 100 index. The Nasdaq 100, as earlier discussed, is the leading market index for the top 100 non-financial stocks in the U.S. listed on the Nasdaq exchange. The large-cap stocks have a high representation of some of the best tech stocks. In fact, the Nasdaq 100 is highly acclaimed due to its tracking of predominant tech companies. Lately, the Nasdaq 100 outperforms the S&P 500 due to 6 of its outstanding listed stocks. Therefore, the Invesco QQQ ETF is benefiting from the fame and magic performance of the 6 stocks: Microsoft, Netflix, Google, Apple, Amazon, and Facebook. The high volatility and open option for swing trading can be beneficial too. Of course, the higher the return, the more expense ratio to cover. This one has a 0.20% cost. Number 1. Vanguard Growth ETF. Vanguard Growth ETF has over $148 billion in assets, receiving only a 0.04% expense ratio. This constitutes roughly $4 in annual fees if you invest $10,000. Remember that before hedge funds such as Fidelity started offering commission-free ETF trading, Vanguard first offered this in 2018 for all its mutual funds and 90% of its ETFs. Today, over 6 hedge funds offer zero-fee ETFs. If the mega cap growth stocks are scary, why don't you start with the CRSP US Large Cap Growth ETF? The ETF holds 266 large cap stocks, heavily targeting the tech industry. The company has 49% of its holding among notable tech stocks like Alphabet, Microsoft, Apple, Meta, Tesla, and Nvidia. Further, you could say that this fund has a top-heavy holding, as the top 10 largest holdings constitute 51% of the total fund weight. Growth stocks might not be in the best standing in 2022 due to the economic situation the world is facing. Thus, one needs to find alternatives to shield oneself from recession. This does not eliminate the fact that some growth stocks can withstand challenges. For our next video, stay tuned as we discuss the 5 best recession-proof stocks to invest in now.